If you want to be able to create predictable results with your money, you need to stop investing for accumulation and giving up control of your money by putting it into a 401k and start regaining control of it and investing for cash flow. If you follow this channel, you know that investing for cash flow is one of the things that I love most in this world. I wrote my book, Cashflow Hacking, simply for that reason. You can see it in the link in the description below. But here's the deal. When you think about cash flow, now the question is like, okay, what's the most effective and efficient way to invest for cash flow? In this video, I'm going to talk about how to use whole life insurance to make your cash flow investing strategy better. I've got an illustration behind me. I've got notes. I'm going to go through all this in complete detail, and I think you're going to like what you have to see. If you haven't already, make sure you subscribe, click the bell, that way you're notified every time I launch a new video. Let's get into it. Hey, what's going on, cash flow hackers? It's Chris with Life 180. In this video, we're talking about how to utilize whole life insurance to invest for cash flow. This is probably one of the questions I get more than anything else in this world, is how to use whole life insurance for investing for cash flow. And so what I did was I wanted to take this complex topic and I wanted to break it down into its simplest parts. So what I did was I had the team put together an illustration, and on that illustration, it shows contributions to a policy, taking policy loans out against the policy, leveraging the policy for real estate purposes, and then showing how the policy cash grows, utilizing cash flow from the investments to pay back the policy loans, and then also showing what is the real estate value at a future date and what kind of cash flow can we expect from that real estate. Now, what I'm doing, full transparency, because it does get more complicated and I want to keep it as simple as possible. So what I did was I looked at this from a traditional retirement planning perspective, right? I wanted to look at this through the lens of, okay, let's assume we're on the same time frame as every other person who's trying to invest, save for 30, 40 years, retire at 65, and go from there. Now, full transparency, we can make this happen faster. I would argue if you do what I'm going to show you, as you start the process and you start to get these results, you're going to find there are absolutely ways to amplify this and make it more effective. That's something that we get into on a case-by-case basis. The purpose of this video is to kind of show a comparative analysis compared to a traditional financial plan and why investing for cash flow is so powerful, and especially when utilizing real estate to invest for cash flow, why that's so powerful. Now, that said, there are other assets. I know there's a lot of people that love Airbnb, which is obviously real estate play, but it's that the idea of possibly using Turo, which is not real estate. It's the same concept as an Airbnb, where it's like the sharing, the kind of like that share. I can't think of the name of it right now. I'm having a blank, but the sharing concept, and just doing that with rental cars, right? And so it can be great. The Turo way, I talk about Outdoorsy a lot, how I rented my camper trailer on Outdoorsy a lot and cash flowed that, for 30, 40% annualized return. On a trailer on Outdoorsy, that can be a great way to do it. The reason I love real estate is because rather than trying to create cash flow with a depreciating asset, you're creating cash flow with an appreciating asset that has a lot of other benefits that go along with it, like tax advantages. So you get to depreciate the asset, getting tax breaks, like pure tax deductions, not deferrals like a 401k. But you also get the appreciation at the same time. So it's a really, really powerful strategy when you combine it all together. And when we tap whole life insurance on top of it, it gets even better. So now what I want to do is I want to share my screen and I want to go over here and I want to get right to it. I'm going to put myself in the corner. We're going to have a conversation. So you can see I got real estate here. You can see we're talking about real estate. So this is the illustration. I want to just kind of get into this really quickly and kind of, go through this. You can see one of the things I want to get out of the gate, we got the $60,000 premium up front. That is a $50K front load into the policy. So imagine somebody that had $50,000 of savings in a savings account. We just had them pop it into the policy with an extra $10,000 a year premium. And then every year after that, you can see they got the $10,000 a year premium. And that goes down till year 21 when the premium drops a little bit, but not significantly. And the purpose isn't to get into everything. What I did was I wanted to show this window right here, right? This period of time of this 10-year window of, okay, if you commit to this, if you stop trying to get these massive returns in the stock market and you just think about, how do I save to invest for cash flow, and what happens if I do this in this time frame. Now, when we look at this, what we're seeing here is you can see this negative right here, this negative 41,000 in net cash value increase. That's because what we did is we took a $50,000 loan out here against the policy and we bought our first property. Now, what I did here is for real estate, what we're doing is we're utilizing that to buy real estate. Now, I wanted to simplify this and say, all right, we're buying, these are the assumptions. We're taking 10 years and our goal is to accumulate 5 houses with this money, okay? With the money that we're saving. We're taking 10 years, 5 houses. The average house price that we're buying is just $250,000, so they're nothing too fancy. This requires a $50,000 down payment, right? That's what it's requiring. So we're using policy loans. Instead of paying cash for the policy loans, we never want to interrupt the growth of our money on the amount of money that we'd utilize for the policy loan. We instead want to utilize the down payment for that, and then we want to take the positive cash flow from the property and pay back these loans, right? Pay back the loans that come out of that. All the while, we're going to continue to make our premium payments and savings like we would otherwise. And you can see here that we're able to, in year 2, because we had this front load into a policy, that obviously, if you didn't have that, it would take a little longer to get to your first house. So instead of 10 years, this may be a 15-year window. That's okay if that's the case. If you compare this to any other strategy when it comes to the stock market or anything like that, this is still going to kick butt compared to anything, right? And so you see here, year 2, you got the first house. Year 5, you got the second house. Year 7, the third. Year 9, the fourth. And year 10, the fifth. So what we can see here, though, is if you take and you assume that real estate is going to go up 5% in value on average over time, then you are looking at, these are the property values right here for each property when you hit 65 years old. So I'm obviously comparing this. Like I said, I want to compare it to at 65 years old. What are the property values? So you bought this $250,000 house today at a 5% inflation rate or appreciation rate for real estate, which obviously we have big years, we have down years. As far as appreciation, just look at the last couple of years and look what's happening right now. We're going through a down cycle, but overall, over time, real estate over history increases at about an average of 5%. You can see that. So this $250,000 house that we bought right here is going to be worth $1.4 million. The next one worth $1.16 million, $1.01 million, $914,000, and $870,000, all over this period of time, right? Like at the time you hit age 65, these are the property values. So what does that mean? At this point in time, you're going to have a real estate portfolio of $5,354,000. So think about this. At this point in time, you've used a total of $150,000 that you invested to create this $5,354,000 worth of property. Now, what I think is important to understand is in this scenario, to keep it simple, because I didn't want to keep stacking it and complicating it and whatever. I just wanted to keep the numbers as simple as possible. You'll notice that as I go down here, there's no more loans. There's no more anything coming out of this policy. Okay. We could absolutely utilize these numbers right here to buy more houses. And you know what? You probably would in real life. I wanted to once again simplify this and dumb it down and kind of be like, okay, worst case scenario, like how does this compare to putting money into the stock market? Because we could say, well, we could invest this $10,000 into the stock market, and what would that be? Well, once again, it doesn't matter how much money we have. What matters is what that money does for us from a cash flow perspective. And you can see now, I go down here, and this is where it gets really cool. I go down here, and you could see at age 75, we have $487,000 contributed, $1.3 million. At age 65, which is the age that we're targeting, you got $799,000. You've contributed $392,000. So you could see it's pretty powerful. So you got $799,000 on top of the $5.3 million, right? So I go $799,000. So that's like $6.2 million, right? So what you effectively done is at this point in time, you've invested $392,000 or saved $392,000 and leveraged it to create over $6.2 million. Now, I don't know about you, but if you do this in any stock market, it's not going to be that much more competitive. And in the stock market, you're not going to get the tax advantages that go along with it, right? But here's the best part. It's not just about what you have, it's about what it provides you. It's not about the value of the property. It's about the fact that if at 65, with a 6% cash on cash return of real estate, which is way more realistic than being able to pull that off on a portfolio of stocks and investments, you're talking about a $321,000 per year income. Plus you're still, if you manage it the right way, going to get the tax advantages of the properties. Plus, from a generational perspective, the asset of real estate transitions to the next generation in a much more tax advantage basis. You get step up in cost basis a lot of the times. There are things that you can do. You want to talk to your CPA about all that stuff. But at the end of the day, we're talking about the fact that you can literally, this is only assuming that I didn't leverage this fully. I stopped buying properties at year 10 into this policy, and these are still the numbers that I came up with. If I extended this to year 20 and I did this more, I would have had probably another, 5, probably another 7 or so properties that I would have been able to buy in this situation, and these numbers would have been compounded even more. So here's the deal. This is why I always say, why do this for 30, 35, 40 years when you can compress it into a shorter time frame? And if you focus on your financial efficiency and you focus on funding this properly and utilizing the cash flow properly, and you don't live off the cash flow too soon and you just keep dumping it back into the system, you can, take what most people are doing, trying to reach financial freedom, at this 65 number, and you can reach financial freedom much, much sooner. Now, what is that number to you? Well, that just depends on what you want your lifestyle to look like, right? That's what it comes down to, is you have to figure out what you want your life to look like. And what I'll say to that is, there is no real clean way to explain this. I think this is the cleanest way. I use an exact illustration. I use policy loans. I showed them on the illustration. We're using cash flow from the real estate to put the money back in the policy, to recapitalize our policy so we can borrow against them for future stuff. Because when we borrow against it, we're never interrupting that money, as long as we're making sure that we're servicing our debt and handling it that way and doing the right things. It grows. We never interrupt it. We have the real estate value growing on the side. The real estate, the purpose is to create cash flow. It didn't even bring into the consideration the tax benefits. It didn't even bring into the consideration the fact that maybe in certain markets, in certain environments, our property values are going to go up in value even more. We can 1031 exchange them into different markets, and we can manage our real estate portfolio in a much more efficient way that's going to create more profit for us. But this is just assuming a long-term buy and hold real estate strategy. It's very conservative, assuming only a 5% appreciation, and assuming that I only use the policy for 10 years to leverage it, when we should do more. Like in realistic, and I guess in all reality, you would leverage it and you would buy more properties. You wouldn't just stop. Once again, what I want to show here, and I think I should go back and I should do this. I think it's important to understand at this point in time, we've got $392,000 that we've contributed, right? So I want to show this. We've got, how do I do this here? I guess I'll use the blue. We've got $392,000 there that we've contributed. And with that said, we've got $321,000 of annual income, right? So this contribution, because you're leveraging other people's money, you're using the cash flow from the properties to recapitalize everything in this system. Your cash on cash return in retirement, because of the leverage and the tax advantages and using other people's money through real estate, you're able to only contribute $392,000 to create $321,000 a year of income, assuming a 6% cash on cash return, okay? That is, if that doesn't resonate with you, if that doesn't hit you right between the eyes, I don't know, as far as the efficiency and how amazing that is and what it can do for you, and the fact that no other asset in the world, no other asset in the world is going to come close. Even if we don't get the 6%, even if we got a 4% cash on cash return, even if the numbers didn't get close to where we thought, I'm using conservative numbers, and even if we didn't get close to those, we're still talking about, let's assume it got you $200,000 a year of cash on, of cash flow, and you've contributed $399 or $400, let's say, and you got $200,000 in annual cash flow from this strategy. Where else are you going to do that? Where you have 2 years in retirement and you're even on all the money that you ever contributed. Plus you have these other assets. Plus you have the net worth of the value. That's just the cash flow. You're not eating into the principal on the value of those homes at all. So the volatility risk, right? The sequence of return risk, all these risks that you have in retirement go down exponentially. And so it's super powerful. The idea of cash flow hacking to me is and it's why I created the terminology. It's why I'm going through this process and I'm trying to share it with people, because I think when you understand this and you understand the concept of investing for cash flow compared to accumulating, when you just see the numbers, like, you can't argue it. And anybody that wants to argue, I encourage you to try it, because like the math is the math is the math. So anyway, hope that makes sense. If you have any questions, go ahead and comment in the comment section below. I will do my best to engage with every single one. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Till next time, have a blessed, inspirational day. We'll talk soon.